So if you guys want to start, maybe just introduce yourself and.
Sure. Hi everybody. My name is Moll. I'm the founder of a small real estate private equity firm, Arcs Urban Capital. The goal of our firm is to invest in generational assets. We're focused right now in the Northeast, and we're basically using everything we've heard today to try to increase shareholder value, including crowdfunding. So I've been following this space for the past 4 years, and we'll likely launch our first 2 deals on some crowdfunding platforms in the next 3 to 6 months.
My name is Ellenoff. I'm with a firm in New York City called Ellenoff, Grossman, and Shole. We're 70 lawyers, 35 are corporate securities lawyers. Here comes Bonnie now, fully refreshed and ready to participate. We have been involved in the crowdfunding. We represent a lot of public companies. We represent a lot of underwriters. We're one of the top IPO law firms in the country. And we seized on crowdfunding about 3 years ago and been very involved in the process with the SEC and FINRA, as well as worldwide consulting governments. We represent dozens of crowdfunding portals and service providers to the crowdfunding industry, and I'm pleased to be here since real estate seems to have eclipsed the venture side of the crowdfunding industry.
Excellent. And Bonnie, just introduce yourself, please.
Sure, Bonnie. Oops. This is on. Should be a little green light.
Where's
There
our
we go.
AV guy?
All right, we got it. Bonnie Burgett, and I am the co-founder of a crowdfunding platform. Although I am starting to stray from using that word to describe us, but we will be publicly raising equity for deals between $2 and $20 million. We're planning on moving into beta shortly and full-on launch after the holidays.
Excellent, excellent. Just out of curiosity, is there just show of hands for anybody from LoopNet here today? Anybody? Perfect. We've been talking about, disruptive technology today, and this is just a little pearl for any entrepreneur out there. Maybe invent a system where you don't actually have to pay to search properties. Just a thought. Anybody who wants to start that? So let's start on crowdfunding. Just show of hands is who's familiar with crowdfunding and what's happening in real estate? Okay, so a few people. Excellent. We're just going to run through what's happening in the industry today and changes that are happening and challenges and that kind of thing, and talk about the disruption of what's happening on the crowdfunding finance side. So let's start off with the panel. We're just going to start off with a quick question. How has crowdfunding started to change the way the average investor invests in commercial real estate? We'll start off with Bonnie.
Sure. Well, I think that's kind of the fundamental idea behind it is allowing the average everyday investor the opportunity to participate in debt and equity offerings that are private. So right now, based on the Jobs Act, you can only solicit to accredited investors unless you do the Reg A, and I'm sure that will touch a lot more on that throughout the panel on the legislation, but unfortunately you're still targeting the same group of accredited investors. So not quite down to the level that you see on Kickstarter and stuff like that, but I think a lot of people that normally were relegated to the REIT industry or friends and family are enjoying being able to look at individual deals.
Excellent. And Benji, sort of the same question to you, but I guess more on the developer front or asset manager front, with regards to how you see it in your own deals and bringing in potentially many investors on the crowdfunding side.
Sure. So there's good news about crowdfunding and there's bad news. The bad news is, and I think this is what Bonnie was touching on earlier when she said that she doesn't want to call it crowdfunding, is that we're not really crowdfunding. We're taking the old real estate syndication model, high net worth investors, family and friends, putting it on nice, pretty online websites. The good news is you could save 15% or more by switching to Geico. Sorry, I had to do that. In all seriousness, basically, the average investor isn't involved in any of the deals that I'm doing. All the deals I'm doing are all high net worth accredited investors because Based on the regulations today, it's way too onerous for us to attempt to bring in, on $1 million raise, to bring in a few unaccredited investors is going to cost us enormous legal fees. Right now.
I'm not sure why everybody looks at me. I'm trying to do good here.
That's because you're the attorney. You're giving free advice.
So just to make sure we understand the conversation, which I think Bonnie and Benji are framing for you, we're not talking Kickstarter, which is called crowdfunding, but that's donations, reward, and pre-order of goods. It's got nothing to do with real estate. We're still talking the sale of securities by and large involving real estate. And the provisions in the Job Act that enable or change some of that are what's called Title II, which allows a real estate sponsor or syndicator to generally solicit this, investors on tweeting about it, going on CNBC, sitting in this room. Heretofore, you couldn't do that. That was a general solicitation which would have violated intuitively the concept of a private placement. Now you can actually do that. You can put it up online, and so long as you only accept money from accredited investors, not by self-certification, which is the old standard, but by what's called reasonable steps to verify, then you can accept money. And the benefit is investors can go online and there will be search capabilities. So rather than be limited to what one individual tells you may be an opportunity to invest in a rehab project somewhere in the greater Boston area, you can go online proactively and look for the type of deals that are profiled to suit your investor criteria. That's incredible, and that's the opportunity.
Excellent. Actually, another question for you, just on those same lines, and that is that, would the industry benefit from sort of a common structure that people would understand? Some of the crowdfunding deals out there right now, they have, different structures, and there's some confusion, I think, with some of the investors on, exactly, how they get out of deals. Would it benefit to have like a common structure that every portal uses?
My view of that is I'm against it, not because it wouldn't be conducive to the industry, but it's the rules do not limit people's ability to do what they've been doing historically. And I think that's a good thing because different investors have different criteria, but individual portals may very well decide to do that privately and contractually, and that's how they're going to brand themselves and have a competitive advantage.
And that is what's going on today. Most platforms now have the way that they've set up their securities such that every deal is done in a very similar way, so their investors become very accustomed to the process of using one platform or another.
Yeah, and I would sort of echo what Doug has said, that while it would benefit the industry as a whole, I think the way there are multiple structures that platforms can take, and then the way that you structure your documents and is how you differentiate yourself. So as someone emerging into this market, I'm looking at other people's documents and saying, well, that's something that I don't want in my documents, and because if I was an investor, that's not a clause that I would want to agree to. And if you're an investor in these deals, you have no voting rights, you have no real negotiation power, you're just accepting what's put out there. And so that's sort of going to separate platforms in the future.
Excellent. Okay, that makes sense. So, just continuing on those lines, how do we in the crowdfunding sort of vertical, how do we help mitigate the risk to some of these investors, Benji?
Well, I think early on, the platforms have to do a good job policing the operators, which I think they've done a relatively solid job of. The big issue is in the future, and actually Bonnie wrote about this in the thesis about crowdfunding, if you're interested. She wrote it a few years ago back at MIT. It's only 200 pages long, but it's brilliant. She basically says this, and I don't know why I'm quoting you, you're sitting right here, but she says, everyone is so worried about not having face-to-face relationships with these real estate operators. And then she says, well, what about what happened with Bernie Madoff? He had 1,000 people who were good friends of him, and they were taking advantage of him, or he was taking advantage of them. Ultimately, the crowd is going to work like it works on eBay or Amazon, where you'll say, okay, I did one investment with this operator, it didn't go great, and their rating ultimately will dwindle and no one will do investments with them anymore. So over time, we're personally of the belief that we better put our best deals up online, because if we don't have a great footprint online, then in 2 years, we're not going to be able to raise any capital.
Gotcha. Okay.
Yeah.
Sorry, Bonnie.
No, thanks for paraphrasing, but the crux of the argument within the thesis was that the crowd is very self-policing, and there's a lot of, examples of that, and I don't think that you're necessarily having to worry about the bad guys and outright fraud. I think when you take it to the internet and you've got a lot of eyes on what's happening, you're self-policing. But my main concern, and where I'm working to differentiate our platform, is bad deals. Because you're putting deals out there to people that don't necessarily understand exit strategy. They're very focused on cash, a huge theme right now. And big buzzword in marketing is cash on cash. And I look at some of these deals and I'm like, I don't know how you're gonna get out of that. You might get an 8% this year, but you're not gonna get your money back. So I think that's a bigger issue within the industry.
Sure. And do you think we need more oversight or more, government involvement to make sure that we mitigate some of these risks?
The real estate industry is a vibrant place of the sale of securities to fund real estate deals, and has been a private marketplace for 80 years, since the 33 Act. So I don't believe that to be the case. I think people need to be respectful that it is the sale of securities to people you don't know. And so while the concept of Title II allows you to raise money from a much broader group of people, which is a good thing, you need to have loyalty to them the same way that you would with have any investors that you're friends and family with. And if you keep that in mind, then I think everything by and large will continue, statistically speaking, to remain without much fraud. Will there be fraud? Yes, there's going to be fraud. But as Bonnie points out, and as well as Benji, is that Benji? Yes, the platforms can't afford to have a problem on this site, because then nobody's going to do business with that site anymore. But make no mistake about it, the revenue model, if I may just switch it for a second, will very much depend upon whether or not you actually need to be regulated, or if you can actually operate like a real estate venture firm or a real estate investment partnership. If you're taking commission dollars, you need to be a broker-dealer, period. There are no exemptions. So if you're raising money from investors and taking a flat percentage of that money off the top, you need to be a broker-dealer. That's a commission-based business involving the offer and sale of securities. And if you're a funding platform that's doing it, you need to be a registered broker-dealer. If you are following a waterfall for your compensation, where you're participating in the future of the real estate opportunity after the successful fundraise, then that's performance-based compensation, and you don't necessarily need to be regulated and have greater oversight.
Okay, no, that's great. Let's switch gears for a second. This is for Bonnie and Benji. Let's talk about this is sort of off script-ish. But let's talk about an actual deal. Let's talk about an actual deal and what that looks like for just an average investor. Let's talk about things like due diligence. What can an investor, reasonably expect from the originator and from the crowdfunding portal with regards to due diligence, and just the flow of things. How does that look for just the average person? Bonnie, if you want to take that.
I'll start with the average deal. A large portion of the groups that are out there right now are doing single family home flips. So that's a huge chunk of the market, and a lot of that is debt. The bigger groups, and we were talking about this earlier, that there might be 60 groups out there right now, but really there's maybe 5 that have 80% of the market and are larger names, and they are shifting more towards commercial assets. And I would say their raises right now are pretty modest. usually it's just a small sliver of the equity, and Benji can actually really talk more because they have raised, slivers of their equity capital stack on a few platforms, but you're looking at 150 to 200,000 maybe on average. I think the average investor is investing about 35,000, and on the larger end, aside from Prodigy Network, who has raised a really significant amount, the other largest deal and very well known was Realty Mobile's Hard Rock Hotel in Palm Springs that was 1.5 million.
So maybe I take a step back and kind of just explain, as a real estate investor and owner, kind of how this process works. So, for example, we'll talk about a deal that I tied up, North Shore of Boston, 50-unit apartment building. Really liked the deal. I have my investors in my back pocket, and I said, all right, well, I can do this with them if I need to, but part of me as a young operator who wants to be seen and branding myself as a forward-thinking investor wants to be on these crowdfunding platforms, and it also gives my investors a best of brand experience. So whereas some other investors might be invested with a bunch of other real estate operators, they might not necessarily get that investor reporting online and basically have kind of that E-Trade experience of owning real estate that you get if you're invested with one of these crowdfunding platforms. So ultimately what happens is I tie up a deal, I go to the crowdfunding platform, and I say, here's how I plan to fund the deal, here's my equity that I have in place if I need it, here's my debt. Would you be interested in funding a small piece of the deal with your platform? And so then what they do, and this is very much a progression, is all these sites have hired, since they've raised a lot of VC dollars, hired real estate experts, so that in-house they have folks who have institutional real estate backgrounds digging through my model, digging through my underwriting, digging through the market, and really making sure that they understand every aspect of the deal as if they were, raising money from pension funds to invest in the deal themselves. So when you look at the deal, then they'll say, all right, well, Benji, we either like the deal or we don't. And if we like the deal, they might, put it online, and then investors will be able to say whether or not they're interested in ultimately fund the deal. Now what happens is these investors are actually on the most sophisticated platforms getting just as much information as an investment committee memo at some of the private equity funds. And, albeit these deals are much smaller, but still they're getting a lot of information. And so they have the information there that likely should help them make the decision themselves if they're reasonably sophisticated, which if they're accredited, hopefully they are.
So in those deals, typically what would the capital stack look like in that scenario? You would obviously be bringing on investors, vis-a-vis crowdfunding, but in a debt capacity, I would assume.
No, probably in an equity capacity, actually. So of a deal that size, the way that for a deal that size, we would bring in probably, let's say it's a $10 million deal. We would bring in 65% of that deal in debt. And, so 3.5 million would be equity. What would happen is we would say, all right, whatever site it is, we're going to give you an allocation of $1 million. So instead of me finding another high net worth individual to give me $1 million, either what will happen is the sites will find me a bunch of individuals that will invest directly in my deal, or they'll create their own entity that will be that $1 million investor. And so that's a business model choice that all these crowdfunding sites are making right now. But for a deal that size, there is not really a debt market. There might be a more mezz kind of bridge financing type market if it's a shorter term deal, like if I was building something and I needed, some sort of capital to fill the construction costs, then there might be, but on a bigger deal like that, there traditionally have been equity on the crowdfunding platforms.
Okay, excellent. And that, from a legal standpoint, with that kind of structure, what should an investor expect? From the originator, from the crowdfunding portal, with regards to information. I know Benji said, typically they're going to have as much information as you'd send out in a memo in a real estate firm. I'm not sure we're seeing that yet, but what should they expect from a legal standpoint?
The first observation I would make is it's incumbent upon people going to the sites to truly understand what the site's revenue model is, because there are conflicts of interest when people are selling these securities. So the first one is, the New York Times, to find a real estate deal, they're just posting a real estate deal that's being advertised there. You wouldn't expect them to do any due diligence. There's a site called CrowdStreet. They just post for fee real estate deals. Don't expect them to do any due diligence. Their disclosure, in fact, on it, will say we don't do any due diligence, nor do they have an obligation to. Other sites that are broker-dealers, if you're a FINRA broker-dealer, you have an absolute obligation of doing full due diligence. That means doing background checks on the principals involved. It means understanding the deal the way Benji's talking about it, and it means selling securities responsibly at values and in a way that investors can understand. And the big emphasis that the regulators want people to understand in crowdfunding is that investors understand the securities and the risks that they're investing in. But it's broker-dealer responsibilities of due diligence, which is as high level as you get. However, since you're all commercial people, presumably, that doesn't give me full comfort, because I've seen a lot of IPOs go off that are too overvalued. I like the deals where there's co-investment from a substantial third party, and if they're really putting in their own money, I think they paid a lot more attention to the details, including how to value the deal, structure the deal, and they presumably will have an ongoing role towards monitoring that deal. And those structures are different than the broker-dealers. Those are the real estate fund-like deals I was talking about before, where your compensation is based upon the performance coming out of the waterfall primarily.
Love that term, monitoring the deal. So, let's take a look at the type of information that's going to be important. And I know Bonnie wants to touch on our thesis a little bit, so we're gonna do that. So let's talk about the data. How important is the data behind some of these deals that are getting done?
Well, so our vetting model is based on data. And I think as all of these deals start to move online, that data is going to become easier. Unfortunately, I know the first panel today, the comp stack, Michael Mendel did not make it, but I think you look at that model, and then you look at hundreds of deals that could potentially be funded through crowdfunding today, and you're building up huge databases that are really going to rival CoStar and Reese and all of those firms. And our vetting mechanism and our underwriting mechanism is dependent on the influx of data and how that's going to change the future of how you underwrite a deal. And kind of going back to what we were previously discussing, there's a very wide spectrum of how these deals are being vetted, from nothing at all to going through the BD structure. And they're not necessarily, they're looking at compliance issues or risks appropriately put out there, but they may not be necessarily qualified to underwrite the merits of the deal. And I think that's when your investors are going to pick and choose between, and really should go out and look at what their vetting mechanism is and how they're who's underwriting that deal before it goes up on the platform. But I think the data component will come further down the road, but it'll be very interesting to see. That will definitely shift the industry in a drastic way. Yeah,
and Bonnie, I think missed the first panel today, and Jeff Finn's comments as well. But what you just said actually dovetails in with a lot of the data topics that happened in the first, within the first panels, and I think it will long-term fit in perfectly. Back to Benji, what do you see as an asset manager and owner, sort of center of the plate? What's center of the plate in crowdfunding right now as far as property type and deal size? Sure,
Deal size probably $5 to $25 million. And what's happening is, like Bonnie said, everyone I don't know what happened to the market today, but it was down 400 yesterday, it was down today. People just want safety and yield. So when they're looking for yield, what happens is the operators that end up on the sites happen to own stuff in, crazy parts of Colorado or California where, we can buy this apartment building and get 10% yields. Well, I'm an operator in Boston, I'm buying an apartment building and get 7 or 8% yields. It might not look as attractive as the 9 or 10% yields when you're just looking at the underwriting. But if you think about the market, it's important to understand that. And I think that right now, people don't really understand that. And so all the deals that are getting funded are in secondary and tertiary markets, value add, white / core plus kind of deals that can get you to those 10% yields.
And that's for commercial. I would say the vast majority of stuff that's still happening is fix and flips. I mean, it's just huge right now. I mean, people look at this like, oh, I understand that single family home down the street from me, can be rehabbed, sold at this price. And there's a lot of people, they want simple. Simple is what's selling right now because it's such a new industry, and there's a lot of trepidation in going into more complex deals, such as development and deals that might be, mixed use that involve, complex lease, structures or, something like that. People just don't understand.
Excellent. So, Doug, on a state-by-state basis, is there something that investors should be aware of? When it comes to crowdfunding, holding times, things of that nature. Is it sort of centric to the, each individual state or market, or is it more of a national thing to be looked at?
Well, it's actually an international opportunity. Crowdfunding is taking off in much more significant ways in other jurisdictions, particularly in England and Australia. France and Italy just announced their crowdfunding initiatives. I was in Southeast Asia twice this summer, so in Singapore and Thailand, they're going to embrace it as well, sooner than the US as it relates to Title III, the unaccredited crowdfunding. But it's certainly all 50 states. I don't think it discriminates, although I would, and there are intrastate crowdfunding initiatives that allow property owners to sell property or raise money solely within the geographic confines of the states that permit localized state-specific crowdfunding. And that's permissible in a bunch of states today. You have to be very careful with how you do it. I would recommend you get local counsel. Massachusetts unfortunately prides itself on having allocated 10 enforcement folks to monitor this state's activity. And William Gavin is a well-known securities regulator, so I'd be very careful here in particular. No, it knows no bounds. That's the beauty of it.
Okay, excellent. So, when I'm an investor, I put in my hard-earned money into a crowdfunding deal. How do I get my money out? What's the? And this isn't a plug just for me, realliquidity.com. But typically, what can they expect in the current condition of the market, and how do you see the future of liquidity of their investments? I'll start off with Bonnie.
Okay, well, most sites right now, since they're doing 506C Reg D, it's under Reg D, and correct me if I'm wrong, it's restricted for a year for resale, right?
It's restricted.
Yeah, so there's legal restrictions on resale, but aside from that, the majority of the documents out there that I've looked at restrict resale in any way. And as this evolves, I think people will probably change their documents because you're now in a class of people that were not previously investors that don't understand the illiquidity of the type of investment in the long-term horizon. So I think that will change, and then also, we really haven't talked about Reg A plus.
You're looking at me now to do that?
Yeah, because we really haven't talked about it, and I think that's a big, just to back up here, the Jobs Act Title 2, 3, and 4 are really the important ones for crowdfunding. I don't see Title 3, the Crowdfunding Act up to $1 million really playing well in this space. You're really looking at Reg E 506C, which is what we've all been talking about, where you're still advertising to accredited investors. But Reg A Plus really has some potential that raising the limit to $50 million, you can go out to the crowd. Fundrise has done a traditional Reg A offering, which has gotten a lot of press. But when that happens, that's going to change sort of the trading, situation and liquidity.
Battery ran out.
Yeah.
Go ahead.
What Kevin is flagging, that's why he's sitting over there, is that investors want a secondary trading opportunity. What I emphasize initially is that 506B, which is traditional placements, or 506C, or even Title III when and if it ever happens, are private placements of securities, first and foremost. And the sites should emphasize that. They're illiquid securities by their very nature, and you shouldn't be buying them with a view towards trading out of them anytime in the future, because that's really not realistic. However, folks like Kevin and others are creating technologies that will more efficiently match potential sellers with buyers. And it's right-minded, it's directionally correct, and it's very good for the capital markets in the private placement world so that people can get out of deals when they want it. I refer to it as the publicification of the private markets, generally speaking, so it's a good thing, and the more liquidity there is on the secondary market trades, and the less people will have to take as a haircut to the intrinsic value, that's good for the primary issuance as well. Reg A, to get to it, it'll be interesting as to your thoughts as to the applicability in real estate, maybe for non-traded REITs, which I know has been a hot market in your world, notwithstanding a lot of what I gather is some controversy in that market as well, in terms of the fees that come off in those deals. But Reg A, the positive about Reg A Plus, as it's referred to, is you can raise up to $50 million. You'll have to use audited financial statement, which is the negative. It's a registration statement like an IPO. It's not inexpensive the way some of these other private placement can be conducted, because you're going to be able to offer the securities to unaccredited investors, and you can publicly solicit them. It doesn't get blue sky clearance for old line, up to $5 million Reg A offerings, but the $50 million, although it's controversial with the states, is supposed to be afforded blue sky preemption. The states are fighting that, so we'll see how that battle falls out. But the good news is you raise up to $50 million for a real estate opportunity, and after a year you wouldn't have any public reporting obligations under the Reg A model.
Okay, great. No, that makes a ton of sense, and I think the really cool thing for commercial real estate is obviously there's just a whole new group of potential investors, and bringing that new crowd, into the space is going to be phenomenal over the next 5 to 10 years. So one sort of question for each of the three of you, and it's a simple question. If there was one thing that we could change with regards to a hurdle that's keeping us from going where we are now to sort of mainstream, what would that be? If there was one particular, you have to pick one, Bonnie. You see seven, I can tell.
Well, I think we've been talking about how many different business models there are, and the reason for that is the extreme complexity of the securities law, and really crowdfunding has proliferated without securities legislation. Obviously, it's not a security that's being sold, but I think streamlining and simplification of how crowdfunding, platforms and portals work is important, and the SEC just has really dragged its feet on providing guidance on the Jobs Act and how to do that.
So the government's in the way. That's your
right.
hurdle. Yeah.
Same thing.
This is what I'm supposed to say, securities lawyers. Listen, the Title III rules, the proposed rules came out October 23rd, and the comments were in by February, and months have gone by, and actually the proposed rules are very balanced between investor protection and capital formation. So I don't understand, well, I do understand, but I don't like that they're sitting there. But the one thing I would say that I think actually is a hurdle, but it's actually going to be in an odd way, is that Title II has no suitability regulations as to basically how much money investors can invest in a Title II campaign. Bonnie appropriately pointed out that the average campaign is individual investment is $30,000,
I think
$40,000.
that's, no one's really tracking it, but I think that's the last number that I heard.
But that's a responsible number. But if you're a real estate professional and you take in more money than that investor, notwithstanding the fact that they're accredited, can afford to lose, trust me, that's when you're most at risk for litigation. Doesn't matter how good a job you've done, if they can't live the life that they were living previously, then you're going to hear about it, and that's going to be the biggest problem for any industry.
Excellent. Okay, well, we're almost wrapped up, but there's one more important question, and it's just a simple one-word answer for the three of you, and I think I know how it's going to go. But Patriots or Jets tonight?
Pass.
Bonnie?
Dallas Cowboys.
Oh, come on! I didn't give you that option. You live in Boston. It has to be the Patriots.
I live in New York, and I'm a hockey fan, so I won't answer that.
Oh, the Islanders, that's your answer. Well, that's great. Any questions for our panelists regarding crowdfunding? Any at all? Go ahead.
Just curious, because we've been talking about basically all the effects that crowdfunding will have on people, like on the consumer. What effects, if any, do you think it'll have on the actual real estate? Mostly because, as you said, it's mostly in the $5 to $20 million space, which has been pretty cash starved before. So, do you think that this is going to have a large effect going forward? We might see a lot more building in that space, or what effect would it have?
I don't think they want us to see more building. I think that that type of asset would become even more attractive to investors and to operators, right? So there's traditionally not been as many operators as at the top end, and then the private operators, which kind of operate below that. It's kind of in between the institutional and private threshold, and I think you're starting to see people move into that space because they realize, all right, I can find a good deal here with good yield and go get part of my money from the crowd. There is potential for cap rate compression, essentially.
Well, I also think that the people that are going to be most impacted are people like Benji and I, actually. The way that I got into this was I went back to school intending to start my own firm, and what's the biggest hurdle to that? I have a great resume. I've worked for, well-known firms, and I'm out there thinking, well, great, I'm going to go have 50 meetings, maybe one person's going to invest, and that's when I was like, crowdfunding is the answer. And Benji has a great institutional background as well, and we know what we're doing, but we look young, and raising money is difficult. So for smart entrepreneurial real estate professionals that are out doing their own deals, I think this is really opening up opportunity. Whether or not those deals get done, I don't know, but you have kind of the option to do that. I mean, I have a friend that will likely crowdfund with our platform once it is up and running, but he branched out on his own and did a $4 million deal, but he scraped around for that equity. And he, is a smart guy with a great background in commercial real estate. And it still is tough. That's a really tough. So I think you're going to see a lot of emerging operators that are able to maybe do some more deals.
Great. Any other questions? No, that's it. Great. Well, thank you for your time.